Now we're going to have a Weenie weekly market update. All right.
Cue music.
Hello, welcome to Weenie's weekly market update, where I give a recap on what happened to the stock market last week and then what I'm looking for this week and this month. So let's get right into it. The recap from last week was we were talking about how the market likes to move in wave patterns. So remember, we're breathing in and we're breathing out. And I'm just going to draw this on the SPY. Again, the SPY is the S&P 500. Most people's 401ks are going to pretty much match the performance of the SPY. But look, we breathe out, we breathe in, breathe out, we breathe in. We just went sideways. We breathe out. We took a big breath in. And last week I was saying, hey, the market is looking like it wants to drop. It's because we had just breathed out. You never usually want to be buying when we're breathing out because you just don't have a lot of margin for profit. So the market sold off aggressively last week. It was a big down week last week. And that was just because of the overbought nature. Again, it is just breathing out. And it also has to do a little bit with seasons. Again, we're talking about how September and October are generally lower performing months for the overall market. It doesn't mean that the market has to drop, but it's just more likely to drop. And I'm even wearing some sweatshirts, some Weenie Trades gear that says Happy Halloweeny. And this year we got Spooky Ween Halloweeny gear. So I always love Halloween season, and the markets might not like it this year. So seasonal, sell-offs occurring right now. We talked about SPXS. This is an inverse ETF, meaning this goes up when the market goes down. If you want to hedge your portfolio, as they say, basically meaning if you buy SPXS, it kind of like locks in some of your 401k or portfolios because this goes up as your portfolio is going down. But remember, you could potentially get some taxes if you sell your portfolio. So that's why you'd want to do something like this. So just some options, some opportunities. SPXS, when we were talking about it, was about 18, and now it's sitting at about 21. So if you bought one share of SPXS, you made $3 per share. Cool stuff. So that's kind of what happened last week. We had the Jackson Hole meeting where our Federal Reserve Chairman Jerome Powell, he's basically adjusting the monetary policy throughout the United States. And he was basically saying, yep, the Federal Reserve is going on course with our original plan. And the market just hated it. That's this big red candle that you see right here on the daily time frame. If we quickly zoom in over here, we can see the big drop that occurred. And this was what they call a rug pull, meaning imagine just standing on a rug and then you get the rug pulled underneath you and you flop over. That's kind of what happened to the market because it kind of happened out of nowhere. But we were prepared for it, right? In Weenie's weekly market update. So basically, the Federal Reserve is just saying, yeah, we're going to be raising interest rates. And what that means is companies can't borrow as much money to perform their business as well. So profits start to go down, revenues go down. Investors are like, well, I don't want to invest in this. So they sell their stocks, and selling of stocks causes stocks to drop, nothing else. And it's just important to remember that the market's kind of like the weather. So think of like the weatherman. He forecasts the weather, whether it's going to be sunny or whether it's going to be raining. At me as a CMT candidate, a chartered market technician candidate, I'm a market technician. So I'm kind of like the weatherman for the stock market. And so think about it. Would you be mad at the weather if it rained? You wouldn't be mad at the weather. You might be a little bit mad at the weatherman if he said it was going to be sunny and it rained. But think about it. If you're going to be mad at the weatherman for being wrong, you should be happy with the weatherman when he's right. And we forecasted rain and it rained. So moving forward into this week, basically what we're asking and thinking about is the market going to continue downward, much downward, or is it going to stabilize a bit? Remember how we were talking about how if we go sideways, that usually favors trend continuation. So remember in this big move over here, we moved up first. That was the trend, up. Then we stayed sideways. So the next leg higher was most likely up. Right now, we've moved down. We went sideways, went up a little bit, and then went down. So now we're going to decide, are we going to go sideways and then lower, or are we going to go sideways and then start to curl higher? Based off my chart information, it looks like we might go sideways, maybe sideways to slightly higher, but then over the month of September, we're still more likely to drop and dig into these lower numbers. So a little bit more market pain ahead for the next month. However, I'm not expecting any sort of crash, just a typical bear market type of downtrend. And a quick trading tip is when you're trading or actively trading like me, or even just taking a trade for a couple days, a couple weeks, a couple months, follow the trend. The trend is your friend. Think of an object in motion tends to stay in motion until acted upon by an equal or opposite of force, right? Newton, let me know if I botched that or not. Something like that. It's similar to the market. When we have trends, they tend to continue until they reverse. And a trend is dictated by higher highs and higher lows. And so that's where I'm starting to draw those trend lines. A downtrend is lower highs and lower lows. So we have to assume that we just started went from an uptrend to now a downtrend where we're making lower highs and lower lows. And we have to expect that'll continue until acted upon by an equal opposite force, which would be buying and demand, and that could push the market higher. So what I'm getting at is that you can trail stop. So let's say you bought SPXS, right? Because you thought the market was going to go down. What you can do is you can then place a stop loss order. And that just means, hey, if the market or stock or ETF in this case comes beneath a certain level, punch me out. That's as much pain as I can take. I don't want any more of it. And if you set that level, that's your stop loss. That's your risk. Now you can walk away from the computer and it's either going to go up or it's going to hit your stop loss. What you can then do is you can move up that stop loss. So now you're just removing more and more risk and you're increasing your profits as you move up that stop loss. So trail up your stop loss along with the trend to capture some good profits. And just briefly, in terms of market moves, the SPY right now is priced at about 402. The options chain expected move, and again, this is a little bit more advanced. We can go into this at another time or ask me about it at Weenie Trades Live. But the market expected move has SPY coming down to this 380 level by the end of September. Otherwise, if the market is going to go higher, you can look at SPY 420. So right now, SPY is priced in at about 402. The upper edge of the expected move for the month is 420. And the lower edge of the expected move, what the market is expecting, is $380 a share. So be sure to tune into Weenie Trades Live. I do very well trading in market turmoil. So if there's ever turmoil in the markets, come tune in and ask some questions and I'll be happy to help. Now let's get back to the talk. I think we have some important questions to answer. Thank you guys for having me.